Welcome to the All Financial Hour podcast with Steve All.
One of the biggest fears early in retirement is a market downturn. It can force retirees to sell investments at a loss, literally just to cover living expenses. And when the market eventually rebounds, those gains are gone. It's something called sequence of returns risk. And financial author Jamie Hopkins tells Morningstar that there's one way to help safeguard against this.
That's not super complicated, but I still see retirees sometimes retiring with really high concentrations in just a couple stocks because they were growth vehicles and they allowed them to accumulate wealth. But that might not be the right vehicle to get through retirement. Wealth generation strategies and wealth preservation strategies is what we're talking about now are different things. So a more diversified portfolio, both among equities and across different asset classes, is really important because it gives us flexibility on being able to sell things at different time periods based off of how they're performing.
All right. So, Steve, how often do you recommend that someone, I guess nearing retirement, they have their portfolio go under what's called a diversification microscope?
I think every time that we do it, if we bring somebody in, one of the first things we're going to do is we're going to run a Morningstar report on all of their assets. If they got 401ks, IRAs, their own non-qualified accounts, wherever they're at, we want to know how much risk you're taking because that risk versus reward. And I usually almost always ask the question. If you come in and see me and I'm sitting there, I'm going to ask the question, on a scale of 1 to 10, where do you rate if 1 is I'm conservative as you can possibly be in the investment world, 10, I'm as aggressive as you can possibly be. I always say if you can't pick 5, which one would you pick? Because a lot of people like to pick 5, so I can't figure out which way they're going, either more conservative or more aggressive. And I remember when Bob and Sally came into the office, Sally said, I'm a 1 or a 0. We ran her 401k for that risk-reward analysis that we're talking about. And when I brought her back in, I said, I just have a question for you. You said you were an ultra-conservative investor. She goes, yes, I am. And I said, you're sitting right now with an investment portfolio that's 95% equities. And she goes, you're kidding me. And I said, no. She goes, well, that's where I put the money in 40 years ago when I started this job, and I've never changed anything. Never done a rebalance. And I think that's the part of most investing that people miss. And that's where he was talking about, I think, the accumulation when we're younger, up to 59 and a half to 60, when we're actually thinking about retiring. That's the accumulation phase. That's done one way. And as he put it, the spending or the decumulation phase is done in a completely different way. Now, I've also get some people that want to take everything off the table at 62 years old. Well, you can't do that either because average life expectancy is to 85. So you got 20 to 30 years in retirement. You still have to have some of your money invested. So that's where we look at it to make those adjustments for you. And that's where I like when he said asset protection. I personally like for that part, I use a part of it to use a fixed indexed annuity. Why? It cannot lose money due to market volatility. Now, if you have a floor of 0, there might be a limitation on how much it can make. That could be a cap. It could be a spread. There's a lot of different things when it comes into that part on how do you protect that asset. And at that point, I could move almost all fixed index annuities have a 10% free withdrawal. I can move the money back in. So I can take the gains off of where I'm currently at and then dollar cost average back into the market. So if you haven't had a risk reward analysis done and you're not really sure how much risk you're currently taking in your portfolio, call now. Ask for that risk reward analysis. Allow myself or my team to sit down and analyze where you're currently at and find out how much risk you are taking and how that could affect you, because you got to remember, we're in the longest bull market that we've been in history. There's going to be downturns in the market. Are we ready for them if they happen? Give us a call now. Ask for that risk reward analysis.
Absolutely. I mean, potentially your risk score could make or break your retirement here. Finding out where you stand with this risk-reward analysis is a great start. 636-230-8824. Again, for this complimentary risk-reward analysis, 636-230-8824. That website, yourmoneymattersstl.com. Well, if you didn't know, you're going to know right now. April is Financial Literacy Month. And it's supposed to raise awareness about, the importance of financial education, something people like Roncina Ray, they missed out on.
I am so glad I learned about parallelograms in high school instead of learning how to do my taxes, because it comes in so much handy during parallelogram season. That's why I owed this year.
Wow, yeah, parallelogram season, yes. That's very true, though. I mean, I'm with her. For sure. They don't teach you this stuff in school.
I think you should know how to balance a checkbook. Now, I would say a lot of people don't know how to do that now because everything's done electronically now, and very few people actually carry a checkbook.
That's very true. But I did learn that in school, yeah.
But no, they didn't when I was in high school. You did not learn those basic things, because I know a lot of it today, it's if I've got $3,000 in my checking account, I got $3,000. Now, I might have the American Express bill that's $1,500 going out 2 days from now.
Right.
And I've got the house payment due shortly after that. And unless you actually have it in a checkbook to find out if everything cleared today, how much money would you have in the bank, I would say a lot of people can't do that. And I think those are the basic things. And then when I look at the idea around credit card debt, when I do the financial analysis, I have very large clients come in and they don't have a lot to worry about. And then I'll have very large clients come in that have very much credit card debt. And then you have to sit here and say, you can't keep spending 125% of your income because you're going to retire one day. And that job's going to go away, and you're going to have to get it out of those accounts. Living on a budget is going to be a lot harder. So those are the things that we have to look at, and I think it makes it so much easier. I like to take it for our clients, their children. Hey, do you have questions? Why? Because companies can't really talk to you about how to do your 401ks anymore, because if they give it, they're giving financial advice. So we bring in the adult children of our clients and say, if you need help, we're here to help you. Why? Because almost everybody says the exact same thing. I wish I'd have known this years ago. So for us to do that, we just said, hey, let's bring their kids in if they want. We're not going to drag them in here. But if they want assistance, even though they're not going to be able to become clients because most of their money's in a 401k anyway, but we can point them in the right direction so that we are not changing the direction when they hit 60 years old because they put too much money in their IRAs and 401ks. So that's the thing. I think just a basic literacy is very, very important. And the problem with credit card debt. I think getting credit is just way too easy today, and abusing that credit is a lot easier to do that, and it ruins most people's opportunity for retirement. A lot of those people that say, I'm never retiring, they got way too much credit card debt. So be careful with that. Be careful.
Absolutely. I mean, credit card debt, you named it, folks just being aware of how their money works, what's the purpose of their money, and that is a big conversation when it comes to preparing for retirement. And then you throw taxes on top of the mix here. Taxes, they don't just show up in April. They are here every single year. They're here all month to month to month. So when someone gets surprised by a tax bill in retirement, Steve, what are the most common things they didn't realize were actually taxable?
Most of the people, it comes out where they never had anything withheld from their Social Security check, but then they had to take a lot of money out of their IRA accounts. So therefore, instead of their Social Security not being taxed, up to 85% of their Social Security could be taxed. That is probably one of the biggest jump that people don't really think about. They'll look at it and say, I haven't had a car payment for years, so I'm just going to take $50,000 out of my IRA account so I can pay cash for the car. Well, then they owe the taxes on it. And if their income was high enough, then they get affected by IRMA, what it's going to cost you for your Medicare if you're over 63 or 65 years old. So there's a lot of things that when you get that income, that stair step on how you're going to be taxed on it is very important. And how do we help people with that? having more than one tax bucket is the best way to do it. What do I mean? IRA accounts. Almost everybody, our generation, 401ks, IRAs, defer. Well, 20 years ago, the Roth IRA came into existence. That's tax-free. And then having money in an after-tax or a non-qualified account that you pay taxes on the gains or the income that it produces during the year. So those are the most important things. So when I come down and all of a sudden you say, I need $5,000, $10,000, where is the best place to get it tax-wise? And the big thing that I look at taxes different than most people is, what's it going to be over a lifetime? Because most of us in the accounting world only worried about one type of tax, how much you owe this year. We don't look at it and say, how much could you owe over your lifetime? And your lifetime goes beyond your passing with an IRA account because your kids have to take it out in under 10 years now. So it could create a tax time bomb for our kids. So I look at it, reducing or eliminating taxes is one of the greatest things that you can do for your successful retirement. So if you've got over $500,000 in investable assets, give us a call. Let us look at it and do a tax analysis to see if Roth conversions might make sense for you and your family for that tax bill over your full lifetime plus the lifetime of the money. Give us a call now. Ask for that tax analysis.
And again, that's complimentary, folks. 636-230-8824. If you have at least $500,000 saved in investable assets, call right now for this tax analysis. 636-230-8824. And also coming up on April 21st and the 23rd, Steve and Tracy from the All Financial Group, they're going to be hosting an educational workshop called Taxes in Retirement. Steve, what can you tell us about it?
What's at Bishop's Post? Reservations are required. We're going to talk about some of the things in the big, beautiful bill and a way that we can look at how taxes are going to affect you and some of the things that we just got talking about. Is my Social Security taxed? How much of it? What about capital gains, IRAs, Roth accounts? We're going to talk about all of those things and some of the changes in the one big, beautiful bill. The thing that I like to remind people is almost everything in that one big, beautiful bill is only a 3 to 4 year deal. I get asked all the time, oh, isn't it great that I don't have to pay taxes on my Social Security anymore? I said, that's not a true statement. It's taxed exactly the same way. All they did is if your income is below a certain number, you get a larger standard deduction. So come sit down and talk with us. Let us look and see if a tax analysis would be advantageous for you. Again, that's Bishop's Post.
Yep, you do need to RSVP. And again, 636-230-8824. YourMoneyMattersSTL.com is, of course, the website. Steve, guaranteed income is hot. The most recent numbers show that annuity sales hit $464.1 billion in 2025, marking the fourth consecutive year of record sales. But a recent survey by J.D. Power found that most annuity owners struggle with the understanding of the complex nature of the products themselves. So how can you help us cut through all the confusion here?
Let's go quickly. 4 different types. I'm trading it for an income. Single premium immediate annuity. I hand the insurance company a check. They're going to give me a check for the rest of my life. And if it's for me and my wife, the two of us. Single premium immediate. Fixed annuity. I'm going to give it to you and the insurance company is going to pay me a rate for a certain number of years. Looks a lot like a CD at the bank, but it's insured by the insurance company. Variable annuities. Your money's in the market. It goes up and down with the market. If the market drops, it drops. Fixed indexed annuity can't go negative. You can't have a negative return due to market volatility. But all of those annuities, the variable and the fixed indexed, have income riders attached to them. That's what you got to understand. What that's costing you, what the income rider is. And when you start to turn on that income, it's going to deplete the asset. So you need to understand that, because a lot of people say, I'm buying it for principal protection. I don't want it to go down due to market volatility. And then they got an income rider attached to it. They don't usually do both ways, don't do well. If you're coming to me and you're looking for protected growth, I don't want an income rider. If you need that bridge between your lifestyle and your current expenses and your income, that is an income annuity. So give me the right tool for the right job. So if you have an annuity and you're not sure exactly what you have, because they are confusing, give us a call. If you're looking for protected growth, give us a call. Or if you need to fill that gap between your lifestyle expenses and your current income, give us a call. Ask for that annuity x-ray. Allow my team to help you know what you have and what might be good for your plan.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.